Imagine a thriving medical giant, raking in billions, suddenly facing a bold challenge to its very structure. Could breaking it apart unleash untapped potential, or is this just a risky gamble on the stock market's altar? That's the electrifying drama unfolding with the Cooper companies, where activist investor Jana Partners is shaking things up by advocating for a strategic split. But here's where it gets controversial. Is this push to separate the company's core businesses a genius move to maximize value, or a short-sighted attack on a leader's vision? Stick around as we dive into the details, exploring why this could redefine the company's future and spark heated debates among investors. At its heart, the Cooper Companies, COO, stands as a major player in the global medical device arena. Picture this: it's divided into two main arms that cater to essential health needs. One arm, CooperVision, specializes in the contact lens world, offering a range of innovative products designed for everyday eye health. Think of their lineup, which includes user-friendly options like MyDay Daily Disposable Lenses for straightforward vision correction, MyDay Daily Disposable Toric Lenses that address astigmatism, MyDay Energies for enhanced comfort, MyDay Multifocal Lenses for those needing reading and distance correction, and the durable Biofinity and Biofinity XR series, alongside Biofinity Energies for extended wear. On the other hand, Cooper Surgical focuses on women's health and fertility, boasting a broad array of products and services. This includes fertility aids, medical devices, storage solutions for things like cord blood and cord tissue, and contraception methods. Key items in their portfolio are the Insorb absorbable skin staples, Lone Star retractor systems, and Doppler blood flow monitors. They also provide handy single-use, cordless surgical retractors equipped with multi-LED lights and smoke evacuation features, plus suction devices with integrated, radial LED lights for better visibility during procedures. For beginners getting into medical devices, imagine these as high-tech tools that make surgery safer and more efficient, reducing risks and improving outcomes in delicate operations. With a stock market value hitting $14.41 billion, or $72.49 per share, the Cooper Companies isn't just a name, it's a powerhouse worth watching. Jana Partners, the activist group driving this change, doesn't disclose specific ownership details or average cost in this scenario, but their history speaks volumes. Founded in 2001 by the savvy Barry Rosenstein, Jana has built a reputation for meticulous activism. Rosenstein coined the term V-cubed for their early approach: value, snapping up shares at smart prices, votes, ensuring enough support before proxy battles, and variety, having multiple exit strategies for value creation. Post-2008, they've evolved into what we call the 3SS, stock price, still key in buying right, strategic activism, pushing for sales or spin-offs, and star advisors/nominees, partnering with top execs for board influence. This evolution shows how activists adapt to market shifts, always aiming for long-term gains. Think of it like a chess master refining strategies to outmaneuver opponents. Now, the plot thickens. On October 20th, Jana revealed their stake in the Cooper Companies and unveiled plans to explore strategic options, such as merging the contact lens division with competitors like Bosch plus Lohm, BLCO. And this is the part most people miss. While breakups often stir fears of disruption, here it could actually strengthen competition rather than stifle it. Let's unpack the backstory to understand why. The Cooper Companies operates through those two vital segments, CooperVision, which drives about 66% of revenue, and Cooper Surgical at 33%. CooperVision leads the pack in contact lens wearers globally and holds a 26% market share, vying with heavyweights like Johnson & Johnson, J&J, at 37%, Alcon, ALC, at 26%, and Bosch plus Lohm at 10%. The soft contact lens market? It's valued around $11 billion and growing 4% to 6% yearly, fueled by trends like the rise of silicone hydrogel daily lenses, since roughly 40% of users still opt for longer wear options, and expanding global adoption. High entry barriers make this a lucrative space with EBITDA margins in the mid-30s, translation for newcomers, that's profit before taxes and essentials, indicating a robust, efficient operation. Cooper Surgical, meanwhile, targets women's health, with 60% of its fiscal 2024 revenue from office and surgical products, Paragard IUDs, stem cell cryostorage devices, and 40% from fertility services, IVF supplies, equipment, genomic tests, donor programs. The global fertility market clocks in at about $2 billion, also expanding 4% to 6% annually. Historically, the Cooper Company started as a vision-focused firm until adding Cooper Surgical in the 1990s, initially as a minor, possibly tax-driven acquisition. But post-2017, they've poured over $3 billion into it, shifting resources from the strong contact lens side. Here's the rub, and where opinions diverge sharply, critics argue this drains cash from a stellar business to fund a weaker one. Evidence? Declining returns on capital, with Cooper Surgical's margins dipping below 2017 levels despite the heavy investments. Management shifts add fuel to the fire. CEO Albert White, formerly at Cooper Surgical, took the helm just as this expansion ramped up. This begs a provocative question: should a company's leader prioritize their personal expertise over the core business? For beginners, think of it like a chef specializing in desserts taking over a steakhouse. Talent can shine, but alignment matters for overall success. Recent challenges have amplified these woes. CooperVision stumbled with the delayed launch of Mighty Energies, mismanaging expectations and hitting growth. Over at Cooper Surgical, IVF demand has slowed, possibly due to President Donald Trump's remarks on potential IVF reimbursements, prompting patients to postpone treatments. Consequently, organic growth dropped to 2% from 7%, leading to lowered full-year forecasts and a 12.85% stock plunge post-earnings. Now, at a 12-month forward P/E of 16.4x, well below its 10-year average of 23.1x, the stock seems undervalued, ripe for re-evaluation. Enter Jana's bold move. They've amassed a significant position and are urging alternatives, like uniting CooperVision with Bosch plus Loam. Antitrust worries? Surprisingly minimal. A merger would yield 36% combined share, trailing Johnson & Johnson's 37% and edging Alcon's 26%, without creating a dominant force. Plus, the businesses complement each other with little overlap in regions or products, easing regulatory paths. Bosch plus Loam CEO Brent Saunders has openly embraced the idea, viewing it as a way to boost competition and scale. But don't stop there. European eyewear giant EssilorLuxottica, ISLOF, could join the fray with even fewer hurdles. For Cooper Surgical, private equity firms like Blackstone, BX, and TPG, eyeing Hologic, HOLX, show interest, but insiders suggest shareholders might benefit more from internal fixes, honing in on high-value IVF, offloading non-essentials, and bringing in fresh talent for a rebound. With short-term hiccups fading, the Cooper Companies has paths to reclaim its premium. Jana estimates $300 million to $500 million in synergies from a vision merger for a company generating $850 million in EBITDA, substantial gains. Yet, persuading management is key, no guarantee they'll agree, especially with their track record. If resistance mounts, this turns into a governance battle, potentially calling for a new CEO versed in contacts to steer back to basics. Jana isn't demanding a change outright, and White might excel leading a standalone Cooper Surgical. But activism thrives on compelling arguments, and Jana's case seems strong. Let's hope leadership listens for everyone's sake. What do you think? Is Jana's breakup strategy the smart play to unlock hidden value, or is it unfairly targeting a company navigating complex markets? Do you agree that prioritizing one business over another could be a strategic misstep, or is diversification the real key to long-term success? Share your thoughts in the comments, disagree, agree, or offer a fresh perspective. This debate is far from settled.